what is at stake for investors this week? Let's bring in Stuart Kaiser, Citi's head of equity trading strategy. Stuart, great to have you with us. How are we setting up into what could be a week full of tape bombs, basically?
Yeah, I mean, I think I'd probably borrow a little bit from everybody around the table, but I think big picture unemployment rate is singularly, I think, the biggest risk to the equity markets. This week, I think it's probably large cap tech earnings because the bar is set pretty high for those, given the valuation, the performance, the concentration of positioning. If you were to get any sort of negative talk about earnings guidance or CapEx guidance, I think you could see a lot of pressure there. So for this week, that'll be the number one focus. But big picture, the unemployment rate for us has probably been the single most important data point we're getting all year, I think. And I think that continues.
All right, Stu, it's kind of hard to come up with a reason why the market might sell off a little bit, even like a little back end fill or something like that. You talk to a lot of really smart institutions. What are they saying? What's the bear case? And are they still kind of stuck in this sort of pain trade where they haven't totally bought back in?
Yeah, I do think there is a little bit of that we're not fully in, just because I get too many questions on S&P up 35 basis point days of why is it rallying? And I think when people are asking about small rallies, it reflects that. In terms of concerns, look, the biggest hedging flows we've seen have been much more in the credit and rate space. So I do think long end of the yield curve, any disruption in credit spreads are probably the two things from a market's perspective that could kind of throw us off balance. As I mentioned, though, tactically here it's earnings and big pictures on unemployment rate. But the flows we are seeing is definitely on the credit side of the ledger.
So what is the best labor number for the market, right? Weighing what the Fed might do, what's the best case?
I think, frankly, a repeat of last month would be great, right? About 150K jobs. Unemployment rate stays at 4.1%. The Fed, I think, is willing to cut into that environment as long as inflation cooperates. And I have a lot of questions, especially from bond investors. Why does the equity market keep rallying? And my response is you've got a 4.1% unemployment rate. Inflation's fairly friendly, and we're debating how many times the Fed is going to cut later this year. It's actually a really good macro environment. So I think anything 100K and above is fine. I think you would need a really big miss on the labor data to really send the market notably lower. So something I think you need to be below 75 or 50K to really get people's attention to the downside.
Stuart, longest stretch without a 1% move, 23 days since the fall of last year. Meaningless or just setting up for the inevitable?
I mean, it matters because I think what it's telling you is, the market is rallying in low velocity way. And we do have a lot of demand, underneath the surface. We're going to buy back something like 1.2 trillion of stock this year. It's a lot of money coming into the market. Vol target funds, systematic buyers are supporting the market. So I think what you're seeing there is a good macro conditions, underlying demand for U.S. equities, and that is just compressed vol straight out. Does it increase risk reward? Yes, and as does valuation, as does positioning. We're paying a lot of attention to that. The only thing I would say is, if you look at the VIX is low at the front of the curve, but the VIX has a term structure, and that term structure is still quite high. So the market is telling you there are kind of landmines out there over the course of the next 3 months that they're paying attention to, and if you're able to squeeze that risk premium out further, it is even more incrementally positive for markets.
Stuart, we're covering a lot of ground with you, which is why it's great to have you here. So let's go back to semis and let's go back to CapEx spending. And to me, that's the part of the equity market that has had relief in the last quarter. Suddenly, DeepSeek doesn't really matter anymore. Everybody's spending away. Is that the consensus of your analyst team as well? And is there anything within there that's either counter to the trend in the view?
I think it's steady as she goes at this point. You look at, whether it's AI power or just the AI stocks, they're rallying materially. I think on the analog semi side, we've gotten a little bit better commentary from management, and that's really helped. That analog semis was a really under-owned part of the market, and I think we've started to see that correct. So, look, I don't really see any dents right now in that trade. Marketing internationally, I'm surprised that a lot of international investors feel underweight the AI trade and underweight U.S., and look, you can't own AI without owning U.S. stocks. So essentially, I think that's another sort of source of maybe incremental demand. So, steady as she goes for now.